Hi everyone and welcome to this new video. This time we'll be talking about a very popular dividend ETF, JEPI, ticker for JPMorgan Equity Premium Income Fund. So what's the investment objective of JEPI? JEPI is it's an income focused ETF. So the manager of the ETF will make sure that the monthly distribution, this fund pays a monthly dividend, are offer at an attractive yield. So they are trying to increase the dividend yield as much as possible using a covered call strategy. If you watched my previous videos, I discussed this strategy in detail. But in a nutshell, when you use a covered call strategy, it means that you are issuing call options. Those call options, you have two objectives that you are trying to accomplish. The manager, by issuing call options, will ensure that the portfolio overall has low volatility. So it's suited for conservative investors. And the second objective is to earn option premiums, because when you issue a call option, you earn an option premium. So those premiums will be added to the dividend that's being distributed. So where's the catch here is that when you apply this strategy, you're giving up you're giving up some of the potential growth of the stock. So you're basically following a conservative way of looking at things. So you're setting a strike price that is decent, and you're just hoping to get earn the option premium and reduce the volatility of your portfolio. So it's a trade-off. And the covered call strategy has been great for companies that issue this type of fund because it increases the dividend yield, and a lot of investors are focusing on the dividend yield, sometimes too much, but it kind of fulfills the objective of increasing the dividend yield to very interesting numbers like 10%, 11, 12%. And also it lowers volatility, so it even attracts even more people who would be, for example, in investing in bond ETF or stuff. They would be drawn into the stock market by this type of products, which reduce volatility and offers a very good income. So all in all, this ETF is made for conservative investors who are seeking income and some moderate growth. The manager to build his portfolio will use three characteristics. First of all, the businesses that has to be part of this portfolio has to be a member of the S&P 500. So meaning it's only large caps. The S&P 500 is the 500 largest businesses in the US. So it's basically large cap, blue chip stocks, large corporation. Also, what I like about this ETF is they add also another condition is that they only select or pick stocks that have low volatility. So this is added and adds another layer of protection for you, and it's a more conservative choice. Low volatility stocks, what they are using is that they're using the beta. The beta is usually calculated over the past 5 years, and a beta of 1 will mean that this stock is as volatile as the market. It will fluctuate the same way that the market fluctuates. So that's one thing to keep in mind. So what they are targeting here is they're targeting S&P 500 plus low beta. So it's going to be only businesses or stocks that fluctuate less than the market. So let's say, for example, if you have a beta of 0.5, if the market goes down by 10%, usually this stock historically went down only by 5%, half of what the fluctuation of the market. And also they use a fundamental approach, which I really like with this type of fund. And it means that this fund is an active fund. So the manager is not just tracking an index. He actually implementing a fundamental approach to choose value stocks. And a value stock, it means that this stock is trading lower than its intrinsic value. So they look at the financial statements, they try to project revenues, project cash flows, and they come up with what we call the intrinsic value, the real value of that business. So if the stock is trading at a lower than the intrinsic value, then it becomes a value stock. So there is a team with JPMorgan. They will select and pick stocks that they think are value stocks, and these stocks have also to be low volatility stocks. So all in all these criteria I find are really interesting and match with the objective of targeting conservative investors, because some of the covered call ETFs, let's say for example QYLD, if you are a conservative investor and you're investing in QYLD, it has only tech stocks, and tech stocks are volatile by nature. And so probably you're not expecting to have a big ups and down, but it will happen because you're investing in tech stocks. And if tech stocks go down, this covered call ETF QLD would also go down. So at least with this fund, you know you're limited to only to low volatility stocks, and you know also that there is a fundamental analysis that has been done to pick those stocks using the value approach. So that's something to keep in mind when you're investing in covered call ETFs, because you don't want to invest in something more risky than you're really intended to in the first place. Now, regarding the fund assets, the JEPI has $14 billion in assets under management. So it means it's highly liquid. So if you're buying, you can sell it. There's a lot of demand for it, and there's a lot of buyers and sellers every day. High volumes, which mean it's good for you, because when you're selling or buying, you're paying really a very small spread. Number of holdings, the fund holds 123 stocks in total. And the dividend yield, as per their website, as of September 30th, they are publishing 13.30%, which is really a very attractive dividend yield for a covered call ETF. Other ETFs offer obviously higher yields, but it goes again with what I mentioned, is that if you are investing in volatile stocks, if the fund manager is investing in volatile stocks, they are able to produce a higher dividend yield, because volatility and option premiums go hand in hand. So when there's high volatility, usually your option premium will be higher, so the fund manager will be able to pay more. But I think for this kind of type of portfolio that that JAPI has, this dividend yield is more than interesting, and makes it a good choice. So why add JEPI to your portfolio? This is some of the arguments that I found in their website, which I agree with. First of all is the additional income. JEPI offers an attractive dividend yield with low volatility. So it's really ideal if you're want to build passive income. And also the fund is diversified, and all the sectors you will see later are represented. Could be an alternative of owning a long duration bond ETF. This again comes to what I said earlier. This type of ETFs, they're targeting people who are just looking for income, and a lot of those investors ended up they were going more on the fixed income side. So these fund managers, JPMorgan and others, they're trying to attract these type of investors to actually to the stock market by investing in covered call ETFs. And also the third objective is to reduce risk of an existing equity portfolio. So if you're owning stocks, let's say you're picking stocks and stuff, and you want a fund that will be like at the same time diversified, and at the same time reduce the volatility of your portfolio, for sure this type of ETF will do the job, especially in the market that we're right now, where there is a market correction and we're headed to a recession. This covered call ETF will protect you against market corrections, and also, but they will also, like if the market picks up, covered call ETFs they're going to have far lower performance than a regular ETF, because as I mentioned earlier, they are selling call options, so they are giving up on the potential growth of the stock that they are on the stocks that they own. So now the overall the positives for JEPI, there is first the attractive yield, thanks to the premium owned, earned issuing call options, the lower volatility. So it's if you want to invest in the S&P 500, here you have a fund that allows you to do that, and even more. In addition to the covered call strategy, they are only limiting themselves and picking only value stocks and low beta stocks. So you're even have a much lower volatility than the S&P 500, with a dividend yield that's much higher, which obviously if you own just the stocks that are within the S&P 500 or an index ETF, your dividend yield wouldn't even exceed 2% or 3%. So this type of fund also suits conservative investors and income seekers. And high volatility, as I said, right now during the market that we are in with this high volatility stocks going up and down, it favors this type of funds. And also it saves you time and effort if you would yourself be interested in writing call options on the S&P 500, which the fund manager is doing that for you. And the relatively low fee, like if you look at all the covered call ETFs, JEPI is at the lower end. They are charging really low fees for an active fund. Also, like they're doing an active strategy, but still they're charging a very competitive fee. Now the diversification, JIPI is highly diversified across various sectors. So this is what I like about this is usually when you pick only low beta stocks, you end up with defensive industries. But in this, for this fund at least, they try to have all sectors represented and not just defensive industries. Now the negatives, it comes to a covered call strategy overall. Like in the bull market, investors should expect a lower performance than the S&P 500. It's okay to chase the yield because the dividend yield because you think it's going to build like passive income and you can earn like a monthly payment, but you have to keep in mind that you're giving up some of the potential growth because the stock market is all about total return. So what's your dividend plus your price performance? So that's what we call total return. So you have to look at the total return. And in this type of fund, if you invested in the S&P 500, for sure you have very low dividend, but the performance potential, especially after we leave this recession and we enter to a bull market or the recession ends, for sure if you own the index, the S&P 500, you will have a far better total return than someone who owns a covered call ETF. But again, it's just a trade-off. If you're a conservative investor, you don't want to probably invest in an index because you know it will be highly volatile. At least with conservative investors, if you'd rather just have some payments on a monthly basis, low volatility ETF, that would be, of course, a good choice for you. Now, the covered call ETF, this is just a table that summarizes what happens with them. In a bull market, they will lag in terms of performance. In a modest bull market, they will outperform the index. The same thing with a volatile market with frequent up and downs, they will outperform the index. And in a bear market, sorry, here it means bear market, they will outperform the index. And this explains why they are so popular lately. That's because we are going through a market correction. So anyone who owns an index ETF has been hit hard. Anyone who owns tech stocks or just stocks in general will be hit hard. But if you had a covered call ETF, not only you will have a good performance, a better performance than the index, and also you will be getting monthly dividends. So it definitely there was a big plus for covered call ETF, and this is why managers and issuers of ETFs are really issuing a lot of this type of funds. Now, for the return for this fund for 1 month, it was 4.95. For 3 months, -1. Year to date, -6. This is -6%. This is really great numbers because if you own an index ETF or stocks, the numbers will be much worse. But as I said, because they are using the covered call strategy, they are able to have a better performance than the index and earn some dividends too. And in terms of holdings, as you can see here, they have 123 stocks in their portfolio. And you see all the big names of the S&P 500 like Exxon, Pepsi, Coca-Cola. So it's some of the defensive stocks, some of energy stocks. As I mentioned, they're all represented. If you look here, you have financial is 12% of your portfolio, consumer staple, healthcare, industrials, information technology, 11%. So you have a diversified fund that what I like here is that I don't see a sector dominating the discovered call ETF. Whereas if you look at some of the other competition, you will have, for example, QYLD is only NASDAQ 100. So you'll have only tech stocks in there. At least with JEPI, you have all the sectors represented. So it's a good ETF to own on its own because it's diversified. Okay, so I hope this information helped you, and if you like the content, please subscribe and hit the like button. And you can also visit my blog. I will put the link to the post where I'm discussing JEPI. Thank you, and have a great day.